Good morning, my dear friends, ladies and gentlemen. I am pleased to welcome you all to the 84th webinar organized by AABN. In this virtual room, I recognize some familiar names of participants from diverse groups. You have all worked tirelessly on the agenda for this webinar series. I am sure at AABN we are also reaching out to many new friends, practitioners, technologists, innovators, and business professionals. A very warm welcome to you all. We all understand the importance of science, technology, and innovation in our day-to-day lives and the ways in which they are transforming the world. Equally important is our collaboration and networking in this great effort. These webinar series are designed to help aspiring entrepreneurs visualize the possibilities, identify resources to support their vision, and understand the logistics of starting a business. This Sunday too, you would be delighted to know that we have an illustrious speaker, Mr. T.R. Suresh, and he will share his thoughts on future game changers surviving the startup challenge. Entrepreneurship is a major feature of this economic landscape. It has been a driver of economic growth, of job creation, and a source of countless ideas, many of which are successfully translated into products and services that touch citizens across the country and around the globe, saving lives and enhancing the quality of life. But entrepreneurship is more than just an engine of economic growth. It is also a factor that makes communities more vibrant, inclusive, and secure. It is the ability to turn an idea into reality, a new venture, a small business that puts rising economies on the path to prosperity and empowers people to come together and tackle our most pressing problems, from climate change to poverty. These are but some of the reasons that we are so excited about entrepreneurship at AABN and are doing what we can to promote it. A spike in inflation and hike in interest rates after the abundant liquidity last year has had a knock-on effect on startup funding as investors cut down on investments to public and private markets, allocating the money to bonds instead. Lockdowns across the world have also impacted supply chains. Add to this the Russia-Ukraine war, which has pushed fuel prices and consequently transport costs. All around, the sentiment has turned bleak, a stark contrast to the euphoria in 2021. Venture funding slowed for the first time sequentially in the January-March quarter of this year since the October-December quarter of 2020. There was intense competition between private equity and venture capital firms over the last 2 years, thanks to the abundant liquidity in the system and rapid adoption of technology, which led them to deploy billions in tech startups. In today's webinar agenda, our guest speaker shall be covering topics ranging from opportunities and threat on Indian economy post-COVID, startup ecosystem, world of private equity and venture capital, Indian fintech industry vertical overview, future of startup investments in India. We have a freshly expanded group of professionals with fresh goals. No wonder we also got an awesome speaker with fresh perspectives on future game changers surviving the startup challenge. Let me extend a very warm welcome to our eminent guest speaker, Mr. T.R. Suresh, Managing Partner, July Ventures Fund, to this interactive business networking session. T.R. Suresh has a bachelor's degree in commerce from St. Xavier's College, Calcutta, and ACA Finance from the Institute of Chartered Accountants of India. A finance professional with over 30 plus years of experience across financial services, hospitality and travel, IT and ITS industries, founder of a boutique corporate finance and SME financial advisory firm, Tatva Capital. He currently is the managing partner at July Ventures Fund, an early stage SCBI approved venture capital fund. He also has an experience as a CFO in Quatra Group, General Manager of Finance in Wipro Spectra Mind, Financial Controller EIH Limited, Senior Manager Treasury and Planning, ITC Classic Finance Limited. His specialities are treasury management, fundraising, M&A, strategic planning, fund management, controllership, and general management. I believe that by participating in this webinar, we are in the right place and the right time.
Give a damn about the whole.
Together, let us accelerate the exchange of ideas and scaling up of good practices. I'm confident that you will find new ideas, fresh energy, and novel partnerships to sustain your efforts in support of our entrepreneurs and recovery from COVID-19. I also wish to place on record our deep commitment to work tirelessly as a team to carry forward our goals in a constructive, gratifying way. I wish you all a very successful webinar. Thank you, and over to you, Mr. Suresh.
Thank you, Mr. Gopi, for the kind words and the introduction. I do have a small presentation which I will probably put up now and walk you through some of the ideas. These are more our thoughts and our experience over what we have seen over these last few years in the venture capital space, and happy to share with you our thoughts um, and experiences. I think while the question answer session has been slotted to the end of the session, but I'd be happy to answer any one of any questions during the presentation on any of the topics. If you could probably just raise a hand, I guess I'll probably try and address those questions. Yeah, thank you, and it's a pleasure to actually meet all of you. And thank you, Mr. Gopi, for inviting me to be participating in this seminar. I think it's a wonderful knowledge sharing session that you've initiated, and I'm amazed at that you've already done 84, 85 sessions. So thank you once again. I'll just pull up the presentation. Just give me a second, please. I hope the screen is visible to all.
Yes.
Okay. I think the topics was something which I think Gopi had already shared on this one. I just want to put it up again and maybe try and put some timelines to it and talk about each of these areas. And as I said, I think I'm open to having questions on each one of them at any point of time. So we'll talk about the economy post-COVID, and again, more from a startup perspective. I'll briefly talk about what I know about the startup ecosystem and the various players that are there in the ecosystem. One of the successful areas that Indian startup ecosystem has done really well has been on fintech, and therefore I'll just give a brief about the Indian fintech area, and then talk about where the startup investments are going forward, and then we can probably have a Q&A session. I've slotted time to sort of around to end the session about 1 p.m., but then of course I'm open to extending it based on the question. So briefly about July Ventures. July Ventures is an early stage venture capital fund managed by a set of individuals who have been fund managers, entrepreneurs themselves, and also managed businesses of large corporates. And we've got together to bring in our experiences and our so-called expertise in helping the startup ecosystem, or at least the startups that we work with to expand and grow. Just a few names. I am a general partner. You see me in the second member of this particular team. We do have a fairly illustrious set of people, and we are also supported by a fairly established entities in terms of helping us scale this particular the fund. I got introduced to Gopi through MBS Money. He is one of the investment committee members of our fund, and we manage the fund together. Yeah. So in terms of our briefly again on this, our advantage is that we are a well-rounded team with experience across various areas. And given that we are a 5-member team, the portfolio to management ratio, or the partner to portfolio ratio, is one of the best in the industry, and that's how we hope to scale up our portfolio companies that much further. I'll skip this next slide because that's I'll just give you a brief that we are a 100 crore fund and SAB registered. These are some of the elements of the particular fund and the commercial structure of the fund. And happy to meet or discuss with any one of you if any one of you are interested in being part of the fund. Going straight into the first topic, which is basically India on a post-COVID situation, and what is the and we are looking at it from a startup perspective, right? So the first element that had to happen post-COVID was a complete recalibration of the businesses by nearly all of the. Just give me a second, please. Yeah. So by nearly all of the businesses, and it required a complete rework of the models that most of the people were. Yeah. Sorry. Most of the businesses were operating in. So this we've tried to actually calibrate, or at least put together some of the businesses in 4 buckets, right? Some of them were obviously structurally organized in such a way where the impact of COVID had been either negative or positive, and some of them were more from a cyclical perspective. So, for example, travel was something which is, because of the lockdowns, obviously the travel had absolutely gone down. And this is more of a cyclical impact, because now after the lockdowns have been removed, we see the pickup of travel happening, both business as well as personal travels or tourist travels happening, and therefore therefore the categorization of those businesses which were cyclical, which got impacted because of the cyclical nature of it, and some which have been structurally affected. Some of the positive pieces that has happened has been obviously because of the lockdowns, most of the businesses have gone online, and some of the businesses are anyway gone, or other even pre-COVID, they had started going digital and online, and this business and these businesses, they just got accelerated, or the digitization got accelerated during these periods. And if you see online groceries, and now we have 10-minute delivery groceries, or 10-minute deliverables, delivery companies, food delivery, right? Telehealth, all of this, gaming, all of this were anyway going the digital route, and it's just got accelerated. And because of COVID, they have now got to a situation where they are at the next level of growth. This is also witnessed, and when we talk about startups, is obviously it's all unlisted companies, but then the listed companies in these areas, it's also getting reflected on the stock markets, right? With regard with the investment sentiment, right? The investor sentiment sort of confirming what we believe are those cyclical positive and structural positive businesses which will keep growing. Most of the businesses, obviously, as I mentioned, have recalibrated their entire models and reworked their entire process flows and all of it to make sure that it is a sustainable and growing business. So this sort of a change is expected to happen every time in the future for any such global changes that are happening, or global issues that keep coming up. So pandemic, and also if you now see, because of the Ukraine-Russian war, there's obviously a lot more changes that are happening, particularly in the supply chain requirements, supply chain process flows, which again, sort of confirm that businesses, particularly startups, need to be very nimble-footed and keep changing their models or rework their models in such a way that they are able to address the global challenges or the environmental challenges, right? I'll move on to the next slide to say, what basically carried through most of the Indian entrepreneurs during the COVID period, right? Particularly the SME segment. Of course, a lot of the SME segment have been impacted had been impacted very significantly, and many of them had shut down. But in India, nearly 1/3 of the business community is SMBs, and therefore they definitely have shown significant resilience because they are now driving the growth of this Indian economy in the post-COVID area. And what has helped them over over this particular period has been obviously these five elements that we have seen, across the early stage ventures that we've been working with. One is obviously digitization. Everybody has gone digital. The by default, every company is currently a technology company. It is, and maybe to somewhere you can also say that they are incidentally doing their other businesses, but then mostly many of them have become technology companies or at least digitized their entire operations. Secondly, there has been a significant amount of collaborative activity that has happened between businesses, which has, many of them have been complementary to each other's businesses and therefore helped both the businesses or multi-businesses to actually grow. Localization has been the other big trend that we have seen, that the focus is obviously go local. I guess even the government, to that extent, with its Atmanirbhar Bharat, the self-reliant India, has been, has understood and therefore focused on creating a local environment in the local area, which will benefit or which will make sure that their businesses, the local businesses, are sustainable going forward. Two other softer areas, which I guess has also made the people, made the entrepreneurs more resilient, has been the social commitment. Nearly all businesses have actually contributed and are benefiting from the social impact that this had, and they are more socially aware. Most of the businesses are most socially aware and contribute in their own way to those businesses, to society accordingly. The other important piece, which I guess has been very important, has been the well-being of the entrepreneur. The impact that such a pandemic and such a situation on the mental frame of mind is I guess, well known. Many people have been impacted globally, but Indian entrepreneurs, to a large extent, have been able to come through the pandemic, again, because of its, I guess, the way they are organized and culturally the way they are structured, right? Strangely, the stress management was, as comparable. It was very well comparable to pre-COVID situations. So again, the entire piece had been about resilience, and the SMB segment particularly, have been extremely resilient during this entire period. And I guess that's the reason why most of them are now moving towards, or at least contributing significantly towards, the next level of growth of India. From a consumer perspective, every area, or from every area or aspect of their lifestyle had been impacted, whether it was work, whether it was shopping, consumption, entertainment, right, travel, health. Everything had been impacted because of the pandemic, and many changes. Most of them have actually gone ahead and made significant changes in their lifestyle to be able to continue managing their households and their personal lives even after the pandemic. But what we obviously are seeing are a few major trends, and this, I guess, is what is driving also many of the startups or many of the early stage ventures to be able to support and cater to these consumer, to what we call as the consumer new normal, right? Definitely, nearly all of them are getting digital. They are by nature getting digital. We see a lot of, the access and aspiration is something which the next 200 million people in India, which is, beyond the urban towns or urban areas where the opportunity is present for, again, because most of them are getting digital. As I mentioned, I think the vocal for local, that sentiment has also contributed to many of the businesses focusing on local requirements and therefore addressing them. The digital footprint and consumption, nearly again, because they are all naturally digital, the footprint of most of the people are on the digital space, and therefore many there is a lot of data which is getting generated, and therefore the newer technologies of AI and ML have actually helped in. Sorry. Hello. Sorry. Yeah, so that is the data that is getting collected with respect to consumers being on the digital medium is being used by startups and ventures to actually put together solutions or put together products and services, right? Which are required by them, right? Are personalized sort of products and services. Sorry. The other, obviously, because of the same reason of people being digital, the media and content consumption has completely, significantly increased. Particularly, video consumption has a lot more increased, and I'm sure you are all aware of the amount of video platforms that are in play, which are something which most businesses are using to communicate with their consumers. Skill development enhancement has completely gone online, and again, multiple areas for people to actually enhance their skills is being developed or being offered, or people are being offered multiple areas or multiple ways of getting their skills enhanced further so that they can cater to the new requirements. And finally, I guess we've also seen a lot of businesses which are moving direct to consumer. The online offline mode still continues for many of the products or services, particularly in the FMCG space. But then many of the newer FMCG products are absolutely direct to consumer. Definitely, many of the non-FMCG products also are moving towards the direct to consumer solutions. So this, I guess, is what the new normal is, and that's how the businesses have to get oriented towards, to make sure that they cater to the requirements of the consumer. The impact of the pandemic primarily, I guess, has been on the way people transact going forward, and businesses today have to be nimble-footed to change themselves to ensure that they are capable to, or they are able to address the requirements of consumers and other businesses as well. I'll stop for a second. If anybody has any questions, I'd be happy to answer. Okay, I'll go on. So we'll talk about.
I just wanted to just add a good healthy agriculture sector also helped. Good rains and
Correct.
Data says that a lot of people moved back to agriculture, and that kind of helped us with the pandemic, dealing with the COVID situation. Just wanted to add to it.
Absolutely, and I think the recovery of India, particularly during the post the pandemic, right, post the lockdown, significantly has been contributed by the agricultural sector. The monsoons has been continuously been good for the last 2 years, and therefore the rural sector has actually gone up, and the rural demand has gone up that much more, which has contributed towards the overall growth of the economy in India post-COVID. I completely agree with you. I think agriculture has been a significant contributor, and when we talk about the next 200 million and the non-metro growth, right, it is actually stemming from the rural areas. Mostly from the rural areas. So I'll just I'll just get on to the next section of what we have as part of our discussion today. It's basically a startup ecosystem, and give you a brief of what that ecosystem is all about, the participants and the stakeholders in that ecosystem, and how India has sort of formed a very strong position in this particular area. So the startup ecosystem, obviously, the main criteria is the startup, and the startup journey per se, right, is something which I guess I know most of you are aware of, but then just to put it in context in terms of the stages of the startup journey, because there are the other stakeholders that are part of the ecosystem. Each of them are different for each of these particular stages, and that's all. I thought it was important that we just talk about the startup journey, right? Starting from obviously the idea stage and the conceptual stage, where significantly it is the founding team which spends most of the time and effort and energy and money to put together the idea and the concept and take it to a level where they actually come up with something which is an MVP or a minimum viable product, right? This stage is what we call as the startup, or at least we categorize it as a startup and seed stage, right? Thereafter, once the MVP is in place, is when the validation of that product happens, which means that you are actually looking to get a few customers on the platform or a few POCs, a proof of concepts of the platform, and a commercial acceptance of the product is what is this stage of early expansion, where the product is now available for a larger audience, and that's when you get into the expansion stage, which is the area where you have the scaling of the enterprise, where you actually are in a position to add more resources, particularly on the marketing sales front, and therefore take the product to a larger audience in the marketplace, in the defined marketplace. And then finally, of course, the later stage is when you get into establishing it as a brand or as a very strong entity in the particular field of its operations, right? So each of these are categorized as I said, the startup seed stage, the early expansion stage, the expansion stage, and the later stage. This is relevant from from an investor perspective, right? If you see the investors, each investor or the type of investor at each of these stages are different. Each of them have a different profile from a risk perspective, from a opportunity perspective, from a opportunity perspective, in the sense that they can write only that much amount of money, or they can write larger checks, right? Depending upon the scale or upon the stage of that particular entity, as well as the profile of the investor, as I mentioned. So the seed startup stage is largely supported by founders, the friends and family, and of course the incubators or the accelerators, right? Mostly it is done that, and the quantum of investment is typically ranging anything between $50,000 to $200,000, anything between 25 lakhs to say maybe 1.5 crores, 2 crores. The risk obviously is the highest at that point of time, and if successful and when successful, obviously this category of investors make the largest multiple of their investment. Could be anything. So if you take an example, the Flipkart founders obviously made greater than 25x of their original investment, right? Because they continued to, they remained as investors until the time they were done. They had a strategic buyer in terms of Walmart buying them out, right? So each stage therefore has a different set of groups or type profile of investors. Angel seed investors and groups, take over from accelerators and incubators after it has reached to a certain stage, which is where we talked about an MVP being in place for the startup. And at this stage, the commitments made by these people are anything between $100,000 to up to about $1 million. Anything between 75 lakhs to 7.5 crores, right? So that is the stage, which is the early stage, and this is we as July Ventures, we actually are participating in this stage largely, but yeah, we do also do some later expansions as well, right? The next stage is where the expansion stage is basically supported by larger VC investors, venture capital investors, which help in the scaling of the company to that next level. And their appetite to write checks is obviously higher, and they have larger corpuses. They are able to write larger checks for each individual investment. Thereafter is when the private equity participants actually come in, or even strategic buyers come in and step in when the business has scaled to a certain extent. You will probably have a strategic investor coming in and buying the startup out completely, or it could be private equity investors who would like to take a significant stake and then take that business to an IPO, right? And that's where the equity markets come into play when the business is actually taken to the market, and the exits. Most of the early investors as well as the financial investors, they sort of make an exit at that point of time, with the founders and the business and the founders and the promoters continuing to take that business forward. So this, as I said, I think each the profile of investors at each stage of the business is different, which leads us to actually talk about who are the different types of investors. So we will talk about investors, accelerators, and we will talk about venture capitalists and private equity players. Incubators, again, as I said, it's anything between the idea stage to the minimum viable product stage. They effectively help the company actually build the minimum viable product. These could be incubators, could be in universities, it could be in colleges, it could be corporate incubators as well, which means that maybe a Microsoft or a Google, their incubation facility, or they provide an incubating facility where these companies are identified, put into a cohort, and then help them develop the idea to a minimum viable product. That's where the incubator sort of steps in and helps out. Duration of the time period for an incubation is anything between 3 to 6 months. So like even in Chennai, I think one of the best incubators that we have is IIT Madras, right? The facility at IIT Madras has helped so many startups to actually, or rather ideas to be developed and taken it to a situation where many of them today are significant or other leaders in the vertical that they are operating in. So once a minimum viable product is made available, the next stage is obviously an accelerator. The accelerator is, helps with funding, a small amount of funding, and at the same time, they help in mentoring. And of course, they do have people who will come, or they have participants, or they have associations where people come in and mentor the startups, mentor the founders and the promoters, and help them scale up. They also bring obviously with them the relationships that they have within the industry, and therefore help in the marketing and sales part of that product, or at least help them get proof of concept (POC) projects to ensure or to take it to the next level, where a venture capitalist can actually step in and fund the scale up of the organization, right? So from a investor perspective, most of the incubators and accelerators fall into what is known as the institutional investments, while angel investing and and of course monies that you collect from friends and family mostly are individuals or high net worth individuals. Of course, there are a lot of angel networks and angel funds as well, which support in the initial stages. But typically, incubators and accelerators you will find as being the first institutional participation in startups in their startup journey, right? So, getting to the next class of investors, which is basically venture capital and private equity. There currently, as I mentioned, over these last few years, right? The line between venture capital and private equity has actually, is very thin, right? Is very minimal. The differences are very minimal, right? Because you have a lot of private equity players also allocating a small quantum of money towards the venture capital space. So what do you mean by that? So let's talk about the differences that are typically there between VCs and private equity funds, right? The stage of investment is something which is very critical. As we talked earlier, mostly private equity players, they play at the later stage when the businesses have gone up or rather scaled up to a certain level, and they are in the way, they're actually looking to grow multiple times from a business perspective. The most of the investment that they put in is substantially towards the sales and marketing of the product or the service, and very less to actually developing the product or building the product or the service. So they participate at a later stage. While VCs obviously take a larger, they have a higher risk, and therefore they take up a larger risk and they invest at an early stage, right? So from a risk perspective, again, so from a risk perspective, as I mentioned, I think the VCs taken a lot more risk than private equity. They also therefore invest into much more entities than private equity, because they try to spread the risk across multiple startups. Many of the failures that happen at the VC level, at the VC investment level, Whereas at the private equity level, unless there is something significantly wrong or a complete change in the environment, most of the private equity investors are sort of protected from a failure of a particular entity. So that's on the risk. So that's the difference. From a structure perspective, most VCs, they sort of actually put out hard cash. When I say hard cash, it is basically funds that they have collected from high net worth individuals or other institutional investors, which is more from a capital commitment to the fund, whereas private equity largely fund most of their businesses, most of their acquisitions, or most of their participations, through leveraging their fund. So in terms of categorization as well, SEBI also has actually come up with different categories for such funds, right? So anyone which is categorized as Cat 1 is considered a venture capitalist who is not, as per law, this is, I'm talking about India, though this classification is not available outside of India. As per the SEBI guidelines or regulations, they are not permitted to leverage their capital. Whereas category 2 and category 3 funds, they are permitted to leverage their capital, which means they can borrow debt and fund their acquisitions or their investments into. Yeah, was that a question? No, sorry. Okay. So that's the structure in which the two operate. Stake significantly, the VC community or the venture capitalists, their investment is not significant in terms of what they have is minority investments in most of the startups that they invest into. Of course, many of them do cover themselves from a control perspective through various clauses in the agreement, but from a shareholding perspective, they only hold a small portion of the investment, right? Whereas private equity firms have a significant ownership, and in many cases, they actually have they actually do. There are buyout funds which actually buy out the company completely by 100%, right? Deal sizes is the other difference. VCs typically invest at less than $10 million, whereas private equity is mostly their deals are in the $25 million range, right? The returns, I think we did talk about the returns that is sort of expected. I'll just go back to the earlier slide where we where we have talked about returns. The returns at the early and the venture capital stage is at a 10 to 20x, so which is obviously the risk is higher and therefore the returns are higher. Whereas a private equity will probably operate at a 5 to 10x sort of returns. So, but on an average, typically most of them have been returning. Of course, the VC on a portfolio basis, they have been obviously returning much more than private equity, but the returns are more evened out in a private equity portfolio because most of the nearly all of the investments in that portfolio actually start giving returns. Whereas in a VC, you will have significant, as we talked about from a failure perspective, there will be failures, but mostly 20 or 30% of their investments actually do multi-blogger returns and therefore compensate for the failures that are there in the portfolio and come out with an average return, which obviously is significantly higher than debt for sure, but also significantly higher than the stock markets, right, which is listed entities. From an involvement perspective, VCs are a lot more involved with the scaling up of the of their portfolio companies. Many a place they actually take up operational roles. To give you an example, our fund is also, we believe in the concept of active involvement in our portfolio companies, because we do believe that the promoter founder bandwidth is limited, and therefore they need to be supplemented, particularly with regard to some of the softer aspects of business, which many of them, again, mostly being tech savvy or techies, particularly in the technology startups, they are not aware of many of these aspects. So whether it is finance, whether it is sales and marketing, or whether it is strategy, that's where I think the VCs step in and get themselves involved that much more closely with the startup founders to help them scale up the business. Exit options, private equities typically look to exit, at an IPO stage or a strategic buyer buying them out. But mostly they hang on till an IPO stage, whereas VCs have different options, including buybacks by promoters or founders, and also a subsequent, a later stage PE coming and buying them out completely. So the key differences being there, right? The private equity, obviously, from a deal flow perspective, they do see, they don't see, again, it depends upon the market, depends upon the geography as well. They are obviously seeing lesser amount of assets that they can invest into at the later stage, particularly in a geography like India, and therefore they have started allocating smaller portions of their fund towards venture capital, which means they actually step in and they have created teams and they are stepping into areas where they take a stake, or they get involved at an earlier stage of a startup than wait till they sort of mature significantly for them to invest into. I'll again take a second to pause here. Any questions? I'd be happy to answer. Okay, just a quick view on how the investment process sort of pans out with the institutional investor community, particularly the VCs and the PEs, right? The three stages, obviously, is where where we look at, for us, for most, for the VC and the private equity market, it is the startups which is the raw material, and therefore significant amount of time is spent on deal identification and deal evaluation, right? Just to give you an example, we are a fund which was launched sometime last year. Since then, we've actually been evaluating. We actually evaluated close to 700 startup deals, right? Of which we've been able to shortlist just 150 of them, and what we are in a position to sort of invest is just about five or six of them, right? So that is a lot of time that is spent on by VCs and private equity professionals, is to spend time on the identification of the deal, right? Which is obviously, when we say deal identification, it's like any marketing sales effort that that any company does, right? Prospective, we have our own channel partners in the form of accelerators and incubators, angel networks, right? We like any industry events, we also participate in events to actually source startups and source opportunities to invest into. So a substantial amount of time is actually spent on deal identification and deal evaluation, right? And thereafter, the execution of the deal, which is basically the diligence and, the documentation, is all sort of outsourced. Nearly all of it is outsourced to entities like chartered accounting firms and legal firms, for them to complete that process and get the deal structured and consummated, and then the investment is done, right? The investment is made. Thereafter, again, the team also starts looking at helping the scaling up of the organization, because it is the ultimate objective obviously is to make sure that we get a significant exit, right, out of the investment. And to that extent, as I said, many of the VCs, they actually get involved very closely with the promoter and the founding team to scale up the business, to help them in every which way, including in a subsequent fundraise, right? And therefore, soon after making the investment, the team, the VC or the PE team, they spend a lot of time in socializing that opportunity with other investors, right? And that is, again, another marketing effort, if you can put it that way, so that the exit happens for the VC or the private equity. From an exit perspective, the opportunity to exit is very different in different geographies. In US and in, say, mature markets like in Europe and US, the exits, sort of are facilitated mostly, by, again, the founders themselves, right? Mostly by the founders themselves, or they sort of, startups just get picked up by strategic investors and they start working on it. However, in India, it's very different. It's very different. It is what we believe is that every exit needs to be engineered, right? So it is the job of the investor to actually work, whether in whichever stage, whether it is whether it's an angel investor or an incubator or an accelerator, a VC, private equity. Every one of them has to work towards making sure that the exit does happen, and to that extent, a significant amount of time is spent by them to make sure that the exit is facilitated. Yeah, so the investment process was important, just so that where the folks in the people in the VC PE firms, what do they spend most of their time in, right? I'll just take, yeah. So this is something which I think, just to bring out to the fact that, why are private markets so popular and so valuable nowadays, right? It's actually a cycle. It's actually a circle. If you actually notice that there is no way, there is nothing which is a start to it and there's a finish to it. It's a complete circle. It obviously started a long time back when VCs and private equity came into play, but then subsequently, each geography has been maturing significantly, and in each of the places you'll find that there are a lot more players that are coming in, right? Whether it is the number of startups that are coming up, right? In India, if the number of startups are phenomenal. The number is mind-boggling, and the number of funds that are being set up, that's mind-boggling. The number of investors who are participating in such startups is also mind-boggling. So all of this is actually contributing towards the growth of this entire market, right? And today it is a complete circle. It moves around. I mean, there are returns are better, so therefore investors are coming in, and therefore because investors are coming in, there is a lot more capital. You will therefore have a lot more companies getting funding, startups getting funded, new startups coming up, and then gets into the same circle again, right? This is something which we believe that it will continue. Of course, there are a few ups and downs that will happen, which we will probably talk about a little later. But as an ecosystem, this is likely to continue completely, right? Just a few thoughts on the Indian startup ecosystem. Right, the sea change has happened over the last decade, right? Largely because a lot of people, or at least youngsters, right? Many of the youngsters have started believing, or at least thinking of entrepreneurship as a career, right? You'll probably come across, and of course, like there have been a lot of the incubators, accelerators being set up in universities and colleges, which has also facilitated, or at least driven them towards the entrepreneurship, and that has significantly helped in growing the ecosystem in India, right? Obviously, the young market is something which keeps on demanding products and services, and that's also driving different and differentiated products and services, which is what is driving many of these startups to actually venture into creating smaller, bringing out solutions to address these particular requirements. Just some numbers per se, I guess this is all known, but then just reiterating, we have the third largest tech startup ecosystem. We have over 100 plus unicorns, and again, the third largest unicorn hub. Over these last 15 odd years, right, the investor ecosystem has also significantly changed, right? We had a few private equity investors from outside of India, large players who used to participate in India. But today, the Indian Indian VC and Indian promoted by Indian folks are also significantly higher, and obviously they have been also able to source a lot more funds from within India as well as from outside of India. So that ecosystem, the investor ecosystem, is also significantly increased, right? Last year, I think Gopi did mention about it earlier, right? It was a watershed year. We did raise $63 billion, all-time high of $63 billion. This year it has slowed down, but while there are concern areas, but we still believe that it will continue, but with obviously some changes. We'll sort of come to that a little later. One of the largest reasons, I think, one of the important change, again, because of the pandemic, has been the penetration of the smartphone as well as Wi-Fi and internet across India, which is again driving consumption in those areas, and again, therefore, the demand for the products and services available, which are available on a digital medium, is been one of the key reasons for this particular change. There are a few other macro influences, particularly the global supply chain, the change in the global supply chain, which has required us to make a lot of changes, and it's also created an opportunity. And I think the startups in India are gearing themselves up to be able to address many of those particular requirements, right? The government initiatives also has helped significantly in terms of enabling these people to actually address those requirements, and we expect that to continue. And I think we do see some fair amount of growth for startups who are catering or working on the supply chain area, right? So just to give you an example, or rather just some areas where the growth is happening. Consumer digital platforms, right? Whether it is education, healthcare, recreation, each one of them has seen some significant funding being made available by VCs and private equity, which has driven the businesses and driven the consumer growth, right? Or the acceptance of the digital delivery of products and services digitally by consumers, right? Similarly, I think a lot of investment has also happened in the SMB space, which has also helped in creating opportunities for SMBs and therefore generated significant amount of value. So some of them, like a phone pay or a Khata book, they have been doing significantly well. One, because of the fact that they are completely digital, and secondly, VCs and private equity has supported them with significant amount of money that is needed for their growth, for their customer acquisition and growth. We've also said, as I mentioned earlier, we've also seen a change in the profile of investors. A lot of people have started participating in the Indian investing in the Indian ecosystem. You have global VCs, of course. A significant growth has happened in the domestic VCs over these last decade or so. A lot of funds are in place. We also have a lot of sovereign funds participating in India, which I guess was not existent till some time back, and now they also see the opportunity to participate. And we have a lot of sovereign funds, and of course corporate VCs, particularly the tech-focused corporates. They, with their incubator accelerator programs, they also participate in significantly in the startup space, right? I'll stop here. Any questions on the startup ecosystem?
I have a question. Does the age of the promoter, does it like, do the VCs look when they fund? That's number A. My second question is, I mean, when you say digital, I mean, do you check what is the reach of a product or service in terms of numbers? You told in terms of fund and all that. What do you think is that threshold level of, I mean, users, or how do you, I mean, what are the kind of thumb rule you apply?
Okay, the first question was an interesting question, to say age of the founder team. Yes and no. In some of the newer areas, newer business areas, or the areas which require a lot more innovation in terms of not just on technology, but also on customer acquisition, the preference obviously is for a younger founding team, primarily because they can drive a few things quicker, faster, quicker, and have the energy to go about doing it, right? But it is not a rule. It is not a rule. It is not something which VCs or private, I mean, the investors, they sort of reject if the promoting team or the promoter or the founder is much older, or at least maybe in his 50s or 60s. Having said that, what is important definitely from an investor perspective is the availability of a second line of command, or the second line which can probably take it forward. And therefore, the way the company is structured and the way the founder is actually facilitating newer or younger set of people coming on board, and the sort of skin in the game that those younger set of people are having in the company is something which is definitely evaluated from an investment perspective. Does that answer your point?
Yeah. Because a lot of people will want to hang up the boots after running for a few years. I mean, I'm talking of that segment of people.
Correct.
Want to relinquish control and say, hey, I mean, now I've been having a handhold kind of approach on my organization. Now I would like to, either go public or expand or let loose. That would be significant number. Children are not interested to take over. They don't want to deal. So these guys are actually substantial in SME sectors, especially in tier 2 cities. They have a fairly decent organization running, and they want to get out actually. My question is, will VCs be interested to kind of get in, step in, find the right CEO, right fit, take it to the next level, and so that it's a happy ending, not shutting down shop?
Correct. I think you're absolutely right. This is definitely a situation, or this is definitely a issue with many SMBs, right? The succession is an issue. In such cases, at least what we have seen, more than VCs, we've actually seen private equity players coming in, taking significant control, and bringing in professional CEOs to take it over and run. And therefore provide continuity to the business and provide that exit to the promoter, right? So that is visible, and that is seen, definitely seen in the marketplace. VCs, yeah, go ahead.
My next question was regarding acquisition. I mean, what number of people like engaging your business or something like that? Does that play? How do you do?
So it is, see, again, at a later stage, obviously, the number of users or number of, I mean, if it's a consumer internet sort of product or a service, then, the number of users on the platform is significant. And that's what drives, and one, again, in the consumer space.
What about B2B? B2B, you may not have huge numbers, but...
So B2B, again, see, at the venture capital stage, we obviously there isn't going to be enough and more customers on the platform, right? They've just started it out, right? Or there've been just commercial acceptance of the product, right? So at a venture capital stage, the number of customers or number of clients really don't impact that much. It is about the market fit of that product. That is what is evaluated that much more. In the sense like, how well is that product going to be used, or at least is of value to the target audience that the founding team is trying to target, right? Now that is the evaluation that is done. It is not about number of customers or number of users that you have on your platform. Second, but yes, it definitely has a impact when you come when an investor comes in at a later stage, right? Because at a later stage, it is about acquiring multiple geographies right, for a B2B product to be able to create value. It goes beyond the geography that the startup is operating in. So at that point of time, the acceptance of the product in a particular geography and the number of customers and clients that they have is of importance. But again, at their evaluation will be what is the potential for acquiring customers in multiple geographies, and that drives the value of the transaction.
Thank you. Thank you.
Hi.
Yeah.
How do you evaluate actually? So are you going to cover that actually, or are you?
Sorry.
How do you evaluate a deal, and what is the process of evaluation and pricing? So how do you arrive at a value for a deal or a company?
Okay. So from again, each I'll talk about VCs because that is a segment that which is growing significantly.
For example, actually, so your July Ventures, you must have done.
Right.
You may not give the name of the deal or thing, but you can give an example, so that we'll have an idea of how an evaluation is done.
Okay. Fine. I'll give you a very I'll give you an example which is in the agri-tech space, right? So there is this there are in the agri-tech space there are there are players who are significantly operating at the what to say, the harvest end of the market. What I mean by harvest end of the market is facilitating the farmer to actually sell his produce, right? In the sense, like either it is warehousing of helping him to do warehousing, or helping him get a market access, which could be through getting him to say food processing industries, or to directly to the market to sell the produce. So those, a lot of people are targeting, or are rather working on that side of the business, right? There are very few who actually look at from the pre-harvest side of it, where the farmer is someone who needs a lot of support during that period. Not just on data in the sense, like I know there are a few companies which also do advisory to farmers in terms of their produce, in terms of their soil, doing the testing of the soil, and suggesting what sort of crops that they should be growing, or what sort of irrigation method that they should be using, all of that. So it's purely advisory. But nobody really supports them, or at least we've not come across people who support them on the inputs that are needed, which is high quality seeds, or good quality fertilizers, which are important, or tools, or even for that matter, tools which will help them in getting a better efficiency out of their land area. And this is more so for marginal farmers, who have holdings less than say 2 acres, right? So that was an opportunity which we felt was important. In addition to that sort of an opportunity which also provided the farmer to fund his purchases of the inputs, right? Or say inputs means seeds, fertilizer, tools, all of those that are needed by them. If there is a credit facility available for them to actually fund that purchase and pay that entire thing out over the period of the sowing and harvesting season, right? Sowing to harvest season. We didn't see opportunities too many opportunities on that, and that is something which we felt was addressing a certain need, addressing a significant need, and particularly the marginal farmers, right, who have very small holdings. They don't have access to any organized uh, what to say program, any sort of organized program. They are not participating in because of the size of their holdings, and uh, uh, that was a significant area that this startup that we analyzed and we evaluated, and we felt that they were doing a fairly good job out of that. So we made the assessment, we did some inquiries. So it was about talking to also the farmers and of course this particular company was also working with FPOs, which is farmer produce organizations. So we sort of spoke with them, met with them, understood the process and the benefit that this team is actually bringing to them, and that's how we sort of took a call to support this particular organization in growing growing that particular business. It's a completely tech platform. The entire what to say financing of the inputs, the supplier of the inputs, all of them are made available on that platform. So they sort of created a sort of a marketplace for that. At the same time, they are also advising the farmer in terms of the inputs. So that advisory part is anyway included as part of it, and also helping the finance organizations by in terms of collections as well, which means that they actually are working as a banking channel partner as well for many of the financing companies that are operating on that with them. Now that was a opportunity that we sort of felt that was good, and that's how we took a call to support that organization. Did that give you to say an idea of the deal and the evaluation process?
Yeah, the evaluation process good, but how do you arrive the number?
So the number typically, again, in most VC funded or early stage funding, it's typically it's a convertible. Normally, it's a convertible. There is no priced round. Invariably, there isn't any priced round that gets happened. So when I say priced round, it means that you don't give a value as of today, but then work on saying that, listen, we will get to a certain or determine the valuation at a subsequent round. When say maybe a private equity investor comes in and steps in to say, okay, we'll take a significant majority or a significant stake in the company, and link your conversion to that particular valuation at a subsequent stage. Unless, of course, there are already, say maybe some price rounds which has happened probably with some angels or say angel network, or say maybe another early stage venture participant already, another institutional participant who has already determined the price, right? So then you invest at that particular price. Here, if none of these are available, it is obvious. It is a working based on the projections that the company puts out, and you evaluate that based on the projections, based on and the evaluation is significantly on the assumptions that has been taken to build that the financial model and the viability of those particular assumptions, and that drives the price, right? So I'm sure you've heard of discounted cash flow methods of valuation or intrinsic value.
How you give it at a debt model, and the future it will get converted into equity at a discounted price?
Normally, it is it's not a debt. It's it's a preference. It's a preference share. Again, early stage, if you take a debt or push out debt, they won't be able to service the debt in the sense like interest payment. So therefore, we keep that keep it as a convertible preference share normally into that. Yes, but it could be at a discount to a subsequent valuation.
Okay, great. Thank you.
So I'll getting to the fintech. I think this has been the most successful startup ecosystem in India over these years. We've been doing fairly well in this particular area, and and we'll briefly talk about the sort of work that is getting done in the fintech area in India, right? To start with, just to give you a brief about the ecosystem. The ecosystem obviously requires all these participants to be involved in some form or the other, or connected with each other in some form or the other to be able to deliver the solution or the service, right? And each of them are significant stakeholders in the ecosystem. So whether it is the financial regulators and the legislature, it is important because they are the ones who define how businesses will be working here, whether it is an RBI, whether it is a SEBI, insurance regulatory authority, or an NPCI, or a pension funds regulatory authority. All of them are involved in defining the methodologies that each of these participants will work. You obviously have the growth in fintech has been obviously happened because our traditional financial institutions have not been able to address the unserved and the underserved strata of the population. So, but they are absolutely essential for this ecosystem to succeed. So the insurance companies, the VC firms, the truck brokers, all of them, right? Finally, of course, the consumers are the important pieces, which could be individuals and organizations. Technology and technology service providers, right? The fintech solution providers. These are again the innovators, right? I would say the fintech solution providers are the innovators who have actually thought through innovative solutions to actually get the financial services products to the mass population, or the mass, or the SMB, or the corporates, right? Of course, supported by technology, right? The innovations in technology has obviously helped a lot of these things to come to the forefront, right? The fintech space in India, we are obviously the third largest fintech ecosystem. We have over 6,000 fintech startups here in India. The adoption has been pretty high. We expect the business to, or at least the volume to be close to 150 billion by 2025. Significant investments have come into India. By 2025, we expect a large growth, on a growth trajectory of about 25%, with investors continuing to participate, because the expectations is that it will probably generate the largest return on investment. And what has driven this? What has driven this particular growth? The most important piece that has actually driven the growth has been the India Stack, right? The open API platforms of Aadhaar, UPI, eNACH, BBPS, GSTN, and the latest, which is the account aggregator, right? Network, or the account aggregator system. These are the reasons why fintech has grown significantly. If these were not there, I guess we would have been fairly, way back in our solutions that we could have provided. I'll come to that a little later. I do have a slide which will basically talk about how these have sort of helped the fintech revolution that has happened in India. The others, I guess we all know, the innovation and technology has helped. the penetration of internet and smartphone is a significant reason why the adoption has been so quick. Demographics, again, large portion of our population is less than the 35 years who always are looking for newer solutions. The investing community have been, large-hearted in this particular area. They've been writing large checks and large amounts for industry, for startups to grow in this area. And government has also been supporting. And one of the, again, along with the India Stack, one large reason why I guess many of these financial inclusion programs were successful, or rather at least we've been able to bring some of these solutions, the fintech solutions, to the underserved and unserved population has been the Jan Dhan Yojana, right? Which basically ensures that nearly every Indian has a bank account, right? And that bank account is linked to a Aadhaar number, it is linked to a mobile number. Now that is a huge plus, right? From a fintech perspective, right? Adoption across solutions, you see in each of these areas, right? We are above the global average, right? Whether it is, and of course, we are definitely the leaders in money transfers and payments across the world. We definitely are doing very well in the other areas as well, but then there is a huge opportunity even now to penetrate even deeper in each of these areas, right? So that is the adoption of fintech solutions. And I think, some of these numbers, some of the numbers that are getting posted, particularly on the UPI transactions that happened, I think last month it was close to some 8 lakh transactions, or 8 lakh crores in terms of value. That, and you'd be surprised that most of that transactions, or the larger value, are nearly about 40 to I think close to 60% of those transactions have been from the tier 2, tier 3 and rural areas. So the adoption of the money transfer, digital money transfer and payments is so deep, is actually penetrated so deep. Yeah. These are solutions which are, the universe, if we can actually talk about this one, the various fintech areas, if we can, obviously there are the solution which each one of them is a sort of the top part is basically the verticals, if you can, or if you may, or the solutions, whereas the bottom is basically is the horizontal that is needed for each one of these solutions to actually happen, right? So whether it is in pay tech, lend tech, digital banking, insure tech, and wealth tech, these are 5 areas where we are seeing growth, and which actually is the fintech universe, which caters to nearly every aspect of it. Products in each one of them are, there are the products that are being packaged are very interesting, and the way they sort of are packaging it, the products is very interesting. I'll give one example in wealth tech, which is an interesting proposition, which looks at digitizing what all of us are familiar with, which is the hundial that we keep at home. I'm sure all of us understand that. The piggy bank, right? We do have, nearly every household will have one box or one hundi, which will be where, you keep putting in loose change, or you keep the money for a particular specific purpose, right? Now, this platform is actually looking to digitize that, mostly because nearly all of the spends today is also happening. I just was talking about the UPI being so widely used. nearly all of the spends is happening digitally, and this platform, right, is looking to round off the spends to the nearest 100 or the nearest 50, and that loose change is actually remitted into a piggy bank, and that piggy bank amount is then can then get used for investing into mutual funds. It could be used to buy digital gold. It can be used to, say, maybe accumulate it in the piggy bank for, say, maybe taking care of your insurance premium, annual insurance premium, or it can also get accumulated for the purposes of paying off your EMI at the end of month. You accumulate it till that particular period, right? And this is something which again is at least the platform is looking to target the underserved and unserved people, because I guess all of us know that they are the last ones to actually look at investments. They are more focused on their daily activities than doing anything else. And while they definitely do have that hundi at home where they continue to keep making that the small accumulations. So this platform basically looks to just digitize that. So some different approaches are being taken by startups in this area, providing or getting financial services to the people. That was just an example of some solutions that are happening here. What do we see as opportunity going forward in terms of where are the larger opportunities that are coming up? Lending definitely is something which is a demand that is required, not just at, till now, I think it was at tier 1, tier 2. It's actually going down further. Ticket sizes are increasing. So digital lending, cashless economy, again, anything which is facilitating transactions without using cash is something, solutions which are built around UPI, built around the digital payments are something which we see coming up, and we see a lot of opportunities there. Insurance technology, while there are plenty of platforms which basically look at, delivering or at least allowing people to write insurance policies and making comparisons of insurance products or different schemes, we see a lot of things happening on the claim management piece, and that's where I think platforms, there are a few platforms which are working on digitizing the entire claim management and making it a seamless exercise for most of them. While we still have cashless situations, cashless policies, but there are still some areas which still require reimbursement claims to be filed, and the process is obviously still very disjointed today. And some of these startups that are working on them are bringing up some interesting solutions. Wealth management, as I talked about, there are interesting platforms that are being developed, which will hopefully get the uninvested or people who have not at all invested, bringing them more to the, more of a financial inclusion perspective. Supply chain, this is a very large area, and it is really, really growing. We see people going deep into each of those supply chain processes, digitizing it completely, making data available in such a way which will facilitate the institutional lenders to lend them, more importantly, on a pure cash flow or a transaction based and non-collateral based sort of lending. And that is something which we see significant movement. Some platforms which are, again, which have sort of created this as a marketplace, like the Threads platform that I think many of you would be aware, which is trying to bring, or at least make it a marketplace, but not successful because, again, a lot of data is not getting captured, which is, I guess, most important for any lender to make an investment. So that we do see a lot of opportunities coming up there. And of course, the latest is obviously Web3. Anything in the Web3 area is something which is finding a lot of interest, though there is, particularly on crypto, there is a lot of restrictions by most governments and most organizations, most geographies, but very interesting opportunities are coming up in NFTs and DeFi, and including cryptos. Okay, so that's another area which we believe will actually grow significantly. Any questions till now, or should I just? Okay. So one conversation that actually is going around is, we start off, at least the section of this discussion, we said that, a vertical perspective of fintech, right? The question is fintech a vertical, or is it actually becoming an horizontal? And that's something which I just want to place out, right? And if you notice the picture, right, the doctor and the nurse are somebody who is actually, outside of, or rather at least they are secondary to the overall piece, and therefore you see a lot of the other people who are associated with financial processes, who are more involved in this particular operation, if I may use the term, right? Now, therefore, is fintech a vertical, or has it become a horizontal by virtue of its application across multiple verticals, or its necessity in every single vertical going forward, right? So let's a few pointers on this, right? Software used to be, or technology used to be its own industry, but then today, I guess every company is a technology company, and I am sure most of you people would have heard this statement by Mark Anderson: software is eating the world. It's basically reducing the entire, bringing it together or making it closer, right? In the same way, I think financial services is also becoming a horizontal, because nearly every single vertical today, which is on the digital mode, requires requires a fintech solution, right? Whether it is healthcare, whether it is edutech, education, whether it is retail, e-commerce. So every one of them is something which, while their main, line, or the main service or the product is related to their vertical, they need the add-ons, and particularly the fintech add-ons, right, for them to be providing a end-to-end product or an end-to-end service to their customer, right? So let's look at, say, maybe a healthcare provider, or the healthcare, this one. He obviously, besides his healthcare solution, he definitely needs, so if he's sort of taking digital payments, he has to integrate with the payment gateway. If he is, in the hospital business, or in the providing clinical or surgical services, or any of the nursing services, he needs to be integrated with insurance, right? if he is looking at supporting a community which requires time to make the payment, so he needs to have a BNPL solution, buy now pay later sort of solution. Now, if you see effectively, he is also a fintech player, right? His customers that he's getting onto the platform for healthcare, they need fintech solutions, and by virtue of that, he also becomes a fintech player. And which is where the next point basically is non-financial companies, they are actually offering financial products. They have to do that. E-commerce distributors, at the time of checkout, you need obviously the payment gateway to take care of it. You need BNPL solution. You need EMI solution. You need to integrate with a credit card company to actually provide an EMI, or a debit card company to provide EMI solution, right? So fintech, therefore, is now, at least our belief is that it is now a requirement, no longer a add-on anymore. It's a requirement to nearly every single business. Okay, so again, an example where it's part and parcel of the product, right? In a driverless car, right? Insurance will actually be some sort of a warranty. I mean, it's sort of is part of that product. When a person buys a driverless car, and it will be, insurance is part and parcel of the price that he's going to be paying for, right? Now it's a given. It's no longer a separate item of that the buyer that the user has to buy for. So therefore, the growth of the fintech industry is obviously going to be much larger because of the nature of it becoming a horizontal, and innovations in terms of solutions or products that different fintechs solution providers that they will bring, again, are going to be it be good to watch for, and going forward as they grow. So again, why horizontal? I think each of this is an illustrative stack in fintech, right? Now, if you look at it, you can actually categorize them in each segment separately, and each one of them are a standalone fintech solution, right? Which is required not only for a full stack player in the fintech area, but as I said, for any particular vertical. So the data layer, which basically ensures that the identity layer, right? Basically, where the identity of the user is sort of defined, whether it's Aadhaar, UPI, whatever, all of that. So that is one layer which is required across verticals. So which is basically the KYC. Now, the health insurance person or the health service provider, if he is going to be providing a BNPL solution, he needs to do the credit scoring of that individual to be able to extend that loan. So each of these areas, whether it is the data layer, the microservices, the macroservices, the application plugins, all of them are something which are some pieces of this will be required under every vertical. And of course, if it's a super app on the fintech area, it is about integrating all of these solutions. Now, what we see is there are multiple startups or players in each of the areas, right? Each one providing a specific solution, and their solution is something which again fits into the B2B segment and not the B2C segment, and on a SaaS basis, on a licensing basis, all of these services that are being provided are significantly growing, and each different types of solutions are coming up on day by day in each of these areas. Just an illustration of what's happening, or rather, what are the uh, pieces in fintech which are moving towards or becoming part of horizontal solutions to the other verticals. Any questions on the fintech?
My question is, with the expansion of fintech, will traditional banks survive at all?
They will survive for sure.
For who? Because you are saying this fintech will reach the unreached.
Correct.
Even otherwise, banks are sloshing with funds and nobody wants to touch anyway. I mean,
no, I agree with you. I think it's not as though our banking system has not been trying to reach that segment, right? Unfortunately, the way that they had gone about doing it and the sort of products that they have come up with is not something which suits many of the people in that area, in that target audience, in the target segment, and that's where I think the solution providers, the fintech solution providers, they are stepping in and trying to get that. Facilitating that financial inclusion of that. Ultimately, the fintech it's a tech platform, right? The delivery of the financial services they're only facilitating. They're more like a distributor of the products, right? The products are still going to be developed or other managed or built by the people who are authorized to develop. So, if you remember the ecosystem that we talked about, right? It is not a standalone. Saying that a fintech solution provider is not someone who's a standalone provider or a standalone solution, right? They need this entire ecosystem. They have to operate within the financial regulations. They have to include the traditional finance institutions. And the traditional financial institutions, particularly when it comes to lending, they are the ones who have the money. So they have to be included. So banks will survive, but banks can survive only if they are open, if they have opened up themselves to working with these fintechs. So a large change that has happened, particularly on banking technology, has been that the core banking systems and the other transaction systems that banks use, they have opened it up through using APIs. They've opened it up. Unless they do that, it's not possible for them to survive.
Okay, thanks.
In terms of co-lending space, that means I think now the banks are encouraging co-lending along with the fintechs.
Yeah.
Who takes the capital adequacy responsibility?
So that's where the regulation comes into play. So the regulation basically says that unless you are registered as a lender or what they call as you have to be registered with the authority, say Reserve Bank of India, either as an NBFC or a small finance bank or a microfinance institution, one of those, right? And the registration requirements are obviously steep, right? So the fintech is not someone who will be able to provide because they are not looking to become a regulated authority entity. So they will work with the regulated entity, which is another NBFC or another bank. So when it comes to co-lending, the model is slightly different in the sense like the lending company actually writes the full loan on their books. But the fintech provider maybe provides some sort of a guarantee for collection of those particular loans. Okay, so it's like they're providing in that parlance, there is something known as FLDG, which is first loan default guarantee, right? Now that guarantee is what is provided by most of the fintech service providers, particularly in those who are lending, because they take on that responsibility of collection.
So then they need to have a capital adequacy, because
The capital adequacy is only to the extent. So they are not governed again. The banks, unlike the banks who have to have that minimum 12.5% capital adequacy ratio, whatever that is defined, there is no requirement from a regulation perspective. But then you are right. The capital adequacy is needed when a bank is wanting to work with it. Right. So when a bank is as part of their evaluation of the fintech of that startup, they will do that evaluation to say, hey, even if you are going to be giving me a guarantee, what is the sort of capital adequacy that you have? Mostly what happens is the banks effectively take a deposit for that particular guarantee. So assuming somebody is giving out, or a bank is actually working with a startup and saying, okay, create a portfolio for me on this particular program for say 25 crores, right? And they are saying you will provide me a guarantee of up to 10% of the portfolio. So they normally take a deposit of 2.5 crores from the startup and say that, listen, hey, you put that deposit with me, and go ahead and get me business on this. That's how normally works.
These guys need not be actually, the co-lending guys need not be registered in NBFC. They need not go to RBI.
No. Under this program, they don't need. If they are going to be lending from their balance sheet, they have to.
Mm-hmm.
They have to. It's regulation.
Great.
Yeah. Okay. Going forward, what is it that we are actually? I think Gopi did refer when we started off earlier today, was the market is obviously getting tightened, right? The funds are getting dried up for the startup to a certain extent. The funds are getting dried up in a different way. When I say it's getting different in a different way, in the sense like what was easily available for any startup, just so. Typically most of the startups had been raising monies on what is the, the criteria, or either the metric that they used to use was the GMV, right? The gross market value of that was getting transacted on their platform. Now that way of, or that process of raising money has probably reduced. Money will be still available. Money is still available to startups because while interest rates are increasing, funds are moving out, hedge funds are moving it more into more to the debt markets. All that is a given, but startup investing still is still an asset class which people are considering, and they continue to keep funding. But the quality will change into moving towards profitability, in the sense like the profitable startups will obviously get that much more funding than somebody who's just driving on the top line, right? Now that is a significant change that is being viewed, that is being seen. We are also seeing that happening. Better startups who are more focused on actually generating profitability out of their operations are in favor, and that's something which is happening, which is changing, right? Valuations, therefore, are getting moderated. Valuations had run up significantly. Again, because of the GMV expectations and the growth that is possible on GMV, that is getting moderated. we talked about Web 3.0. There's that newer areas are still being viewed, and significant amount of money is actually getting committed to such such platforms, right? While there is stock of funds getting dried up for the other areas, but in this area, what we have viewed, what we have seen is that there is significant amount of investment happening. Okay, so getting again, I think the same point about unit economics is primarily driven by the profitability and not just by GMV. IPO exits, the momentum will be there, but I guess some of these what to say bad performances of listed companies like Paytm is probably driving the IPO market. We do believe that there won't be significant amount of IPOs from startups, or at least companies which had been planned. They'll probably postpone it to a little longer time, right? Some of the changes that we see is because of those, the way the IPOs have performed. We expect SEBI to tighten the norms for IPOs. The cryptocurrency, we've already seen the change that has come in terms of the taxation on all crypto products, not just on direct taxation, but indirect taxation as well. So while it is not at all, it's obviously not good for the growth of that, but I think the moderation we will still see happening over a period of time. Other countries outside of India definitely are changing many of those regulations, and which facilitate the growth, particularly from a nearshore perspective. I think Singapore and Dubai, Middle East, United Arab Emirates, UAE, are making significant changes and looking to attract a lot more on the Web 3.0 area. Talent challenges will continue, but again, particularly on tech resources or tech talent, the numbers had actually gone up significantly in terms of expectations of salary and compensation. That is likely to moderate going forward. So that is something which we see as the future, or at least in the next 12 months. Can't talk too much about in the future, but we still see opportunities in startups, right, which can be multi-bagger returns in the future. Okay, just a listing of some of the government initiatives that are available for startups. I guess all of this is probably available on the web, but just a small listing to say that the government is fairly supportive of the startup ecosystem, and I think a large change in this ecosystem has happened because of these government initiatives over this last decade or so, right? And that has helped the growth of this particular system. Another important thing that we see happening in this ecosystem, in the startup, is about building the platforms in India, for India, but for the world as well, right? Just an example of some of the, and I mean, again, we've taken it from the fintech space, right? We do see a lot of the platforms being created or being made available for use in other geographies. Some of them are difficult from a portability perspective, in the sense like they are highly regulated, and therefore they address certain highly regulated areas, but a lot of them are free to be used in any other geography with minor changes. And this is something which we've seen many of the startups approaching, which is they've built it for India, built it in India, they've built it for India, and they're now taking it to the world. So this is again something which we see that is happening in the startup. Thank you for your time. I hope we've been able to bring up some of our thoughts and views on this on the startup area, and happy to address any questions.
Thank you, Suresh, for the outstanding session. Your perspectives are very refreshing, and we had a lot of takeaways today. So I'll leave the forum open for question and answers. Participants, participants, you may please unmute and ask your questions, please.
Yeah, Mr. Gopi, can I ask a question?
Yeah, please go on. Please go on, Mr. Meenakshi.
Yeah, good morning, Mr. Suresh. Actually, this program is we have learned everything about the startup scenario in India. But I want to ask one particular question. We are in the travel industry and the hospitality industry for the last 25 years. But after COVID, what is the situation now? How we can develop, like Make My Trip and Booking.com and Expedia? But we have ideas, but how to get that startup, and then we want to do the same, like we want to compete with the same international group. Can you give some idea?
Sir, travel has obviously been affected by the pandemic, right? Obviously, people have just stopped, but we see a complete change in that. People are definitely, I guess what is happening right now, at least in the personal travel, has been revenge travel, right? So while travel will keep growing, I think what is needed, see, a typical solution is not something which I guess users are too keen, right? And they are well established, and particularly if you are in the B2C side, the cost of customer acquisition, whether digital or offline, is prohibitively expensive. So having said that, people are still looking for solutions, right? And therefore, when I say solutions, and particularly in travel area, I would think they are probably looking for experiences. If experiences can be packaged, or I think there'll be a lot more opportunity, a lot more to grow over there. While the existing platforms will still cater to the typical requirement of a flight or a train ticket or a hotel booking and all of that. But so I think two things. One, I guess we will have to be creating these experiences and also very clearly defining the target segment that you want to approach, right? Because whether it is, when I say experiences, it could be any type of, whether it is a religious or a pilgrimage type of experience, or is a complete family experience, or a luxury experience. All of them, you have to define it differently. Each of those experiences, creating the back-end product obviously is pretty time-consuming and expensive. So you need to therefore define the target audience and then go ahead and do that. Unfortunately, we don't track, at least I don't track too much on the travel area, and therefore I'm not able to probably respond to you, giving you a different perspective. But this is a general feel that I know, at least we've been sometimes discussing about this area.
Thank you very much, sir. Thank you for your feedback.
This is Tirupati here. I'm just working on a startup idea on the loan against shares lending.
Right.
So I am planning to take this forward. So I need some help. Can I get in touch with you and
Sure.
how do we take this forward?
Yeah, sure.
Can I get your email ID or?
You could, yeah, so instead of info@juliaventures.com, you could just put it as suresh@juliaventures.com.
Okay. So suresh@juliaventures.com.
Yeah.
India and I'll get you connected. So then I think you can give me your inputs. Yeah, I tried to multiple number of peoples. I'm just trying to see instead of starting and going to a certain stage and then seeing whether it's going to work or not. I'd like to just check whether what is the flaws or what is the models that I should buy.
Sure.
And July Ventures, does it help in seed funding also? That means, or it's only after a certain stage only you?
Yeah, so we normally look at investments where there is a commercial acceptance of the product, right? Which means that it is beyond the MVP stage or beyond. We definitely don't look at investing at least our mandate does not permit us to look at idea stages.
Mm-hmm. But you will be able to definitely give an input that yes.
Sure, absolutely. So I'll definitely share with you what I see as opportunities in this area.
Okay, great. Thank you.
Thank you.
Yeah, participants, you may please unmute and ask your questions, please. I think there are no further questions, Suresh.
Okay.
Thank you very much for thank you once again, Suresh, for an excellent presentation.
Thank you.
It was very informative. We had a lot of takeaways.
Thank you for inviting me to this webinar. I hope I've been able to share some thoughts in terms of what this space is all about.
It was really wonderful, and you had a lot of base. You have a lot of data to show, and a lot of things that you guys have worked on.
Thank you very much. Right.